and it's time to place an order to buy euro at 120.43, just right here. So if you want to place a trade, if you want to trade euro, here is the time. I'm going to buy at 120.43. All of you guys, if you follow this trade and if you know the strategy, you know what we're doing. And good luck. Hopefully we will get filled soon. Speak to you later. Bye.
With COVID, because it's really about COVID really driving the economic recovery. That, of course, feeds into the reflation trade, yields, everything else that we're talking about here. Of course, news of that J&J vaccine coming over the weekend. Of course, more importantly, yesterday we learned that the U.S. already shipping out 4 million doses. That expected to arrive at those distribution centers as soon as tomorrow. And, of course, you have J&J saying they'll get about 20 million doses out there to folks by the end of March. So an encouraging sign here. You're seeing all the vaccine makers here get a bid here. In fact, all the COVID stocks are really doing well. Flip up the board because there's two interesting stories outside of this. The first, of course, we just have to start this morning by sort of lifting our coffee cups to Jane Fraser. She starts her first day on the job as CEO of Citigroup, third largest U.S. bank out there. And, of course, she's going to be the first woman to lead any of the mega U.S. banks here. She's got a lot on her plate, of course, dealing with a lot of those OCC requirements on compliance. And another interesting story that kind of crept out on Friday, this involving Walmart and two interesting executives, Omar Ishmael over at Goldman Sachs and David Stack over at Goldman Sachs as well.
What do you think, Romain?
Both of them were instrumental in sort of helping Goldman sort of create a more consumer-facing side to its business. They're going over here to Walmart. Walmart has made it very clear now for several years that it is pushing deeper into financing, deeper into consumer financing. Of course, we all remember the brouhaha 15 years ago when it tried to become an industrial bank, or at least filed for a charter to become an industrial loan bank. Everyone pushed back on that. Not only have the rules been relaxed then, but really the environment has changed so much now. I mean, you don't really need to even go the charter route if you want to offer financial services. There are a whole host of consumer finance companies out there, the so-called fintech companies, that have shown you don't need to do that. They've been taking a lot of crumbs off the plate of Goldman Sachs, Bank of America, and the like, and now you have Walmart, just a major behemoth.
Romain, to me, it's been a 40-year mess. I mean, it's been an experiment for 40 years, and it's never happened.
Well, it's never happened, and maybe Walmart's one of those companies that are going to make it happen. And I would just push back on that now. You've got a lot of small players out there, or medium-sized players out there that have shown that they can make it work. Now, whether they grow to be the size and really challenge the Citis and JP Morgans of the world, that remains to be seen. But at Walmart, of course, they've made it clear that they want to make this push. And those two hires are significant. I mean, this is, you know, we're not talking about scrubs here. We're talking about all-stars. You know, they're picking LeBron and they're picking James Harden, and they're saying go out there and take those shots.
He doesn't get basketball, Romain.
I'm sorry, should I
just
be talking
baseball?
Soccer?
You've got to talk baseball. You've got to talk baseball.
Just say Gareth.
Do I know as much as soccer as Tom does?
Even if you name some soccer names, Romain.
It's like Gareth and Harry. I mean,
that's right. Gareth and Harry.
Gareth and Harry.
Thank you, Romain.
I know as much as you do.
Don't confuse him, Romain.
All right.
Very good.
Romain, thank you.
This afternoon is, well, John, I want you to bring in Matthew Hornbach. I'm just going to say I love this guy because he started out off the trading desk of Morgan Stanley in Tokyo and really learned a lot about how not to lose money in the odd yen and Japanese debt markets. That makes him unique.
Matt, fantastic to catch up with you, sir. Matthew Hornbach, Morgan Stanley head of global macro strategy. So, Matt, a number of weeks ago, you put out a note about why it's time for real yields to take over. Real yields are going to move high. You expected it to be a gradual move, and we got a violent one. What was the takeaway for you?
Thanks for having me on, John. It's nice to be with you again. You know, our takeaway is that the economy is going to improve more than most people expect in 2021. That's been the call of our economists, both in the U.S. and globally. And we think that real yields are starting to wake up to this fact. So, you know, yes, we have been expecting a gradual move. And over the past 6 months, it has been gradual. But over the last week, the nature of the move did, in fact, change. And in fact, on Thursday, and this was mentioned earlier on your show, Thursday really was a violent move. It was one where the Fed, probably for the first time in the past 6 months, got a bit of a rude awakening.
I think it's really important to mention the nature, the character of the move last week, Matt, because on the week, nominal yields were up about 7 basis points on the week, but it's the volatility in between and that violent move Thursday. How do you think that shapes the approach of Fed speakers this week, particularly Chairman Powell this Thursday?
Well, we think it serves to highlight a disconnect between the pricing of Fed policy in the bond market and where the Fed thinks appropriate policy is likely to be in the next several years. You know, what we saw at the end of last week is the bond market pricing in 75 basis points worth of rate hikes through the end of 2023. And that, of course, contrasts pretty dramatically with the Fed's view of appropriate policy being unchanged, being no rate hikes. And so that's something that the Fed is going to have to deal with, we think, in the next couple of weeks. They should be discussing this at the March FOMC meeting. And if we're lucky, John, we may even have yield curve control come up as a question, probably from Michael McKee, who's one of the better reporters in the beat these days.
You got that right, Matt. And of course, he'll have to go last because they can't stand the direction of his, the distinctive nature of his questions.
Okay, guys.
Matt, I want to go.
Position open at 120.43. Long position. Okay, well done. We open just right here. So let's see how much profit we're going to make. Okay.
Catharsis to clear the market for the Zentner call.
I think so. I think the violence of the move, I mean, just the fact that after the 7-year note auction, which tailed pretty badly, you know, probably washed out a lot of weaker longs in the intermediate sector of the yield curve. Hard to hold on to a position when it moves that violently against. So I do think that that was enough probably to clear out a lot of bad positioning in the bond market. But as we saw, and as I mentioned, it really brought the pricing of Fed policy to a level that we haven't seen since the taper tantrum in 2013. And we did this analysis in our last institutional research publication, where we saw back in September of 2013, we were pricing in as much term premium in the front end as we are as of last week. So, you know, I think that the market is going to take some of that back in the next couple of weeks. And look, I hope the Fed realizes that they're really playing with fire here. If they allow this to continue, it will continue because the bond market vigilantes, they've got pitchforks out.
So what do you think the Fed should do?
Well, look, I think they need to acknowledge either that the market is onto something, that, look, maybe no hikes through the end of 2023 is a bit too dovish of a policy prescription, or they need to push back in some way, probably verbally. But also, I do think that the tool of yield curve caps was designed for exactly this scenario. So I certainly don't expect them to implement a yield curve cap, but there's no harm in talking about it, especially given where markets are priced today.
Meanwhile, even as we saw real yields rise pretty precipitously at some points last week, we saw inflation expectations over the longer term fall to the lowest levels of this year. What do you make of that? Is this a reliable gauge? We take a look at break-even rates as an inflation measure, or is the market telling us something we really have to listen to?
No, Lisa, I do think it is something we have to pay attention to. Our view is that break-even inflation rates today are mostly being driven by the risk premium embedded therein. And the Fed does need to pay attention. And I think what we saw last week was this. Look, if the Fed allows the pricing of policy to become any more hawkish, they really start to risk their inflation goal of modestly overshooting the 2% level. So they do need to pay attention.
Matt, final question from me. You brought up the vigilantes, of course, coined by Ed Yardeni back in the 1980s. And most people assume that term basically means it puts pressure on the policymakers, not monetary policy, on the fiscal policymaker. Now, you're looking for 170 year end on a US 10-year. Do you think any of this price action that we're seeing right now really puts pressure on the fiscal policy story down in D.C.?
I don't think so just yet. I mean, on any historical measure, interest rates are still extraordinarily low. If you look at the 30-year long bond yield, that is still below the Fed's vision of where neutral policy rate is, which is 2.5%. So we still are at historically low levels of interest rates. I do think that there's plenty of scope for more fiscal stimulus, and it looks like, John, we are going to get it.
Matt, good to catch up, sir. Send our best to the team, won't you? Matt Hornback there of Morgan Stanley, the head of global macro strategy. Tom Keene looking for 170 year end now on a US 10-year yield. Right now, 144.
You got 170, and it's how you get there, and it's the speed, John, that you get there. And critically, to Zentner's call, it's the underlying economy dovetailed around that yield, and that takes data. The data's a little bit delayed.
What you get from the strategist, Tom, is a lot of thought. You never get them turning around and say, we'll get there next week, given the price action of the last week.
That,
but
John,
who knows?
This is such an important thing, is how the street consumes all the guests that we talk to. And you're right, it is food for thought. It's food to help you frame your belief, your setup in the markets, not buy, hold, sell.
Lisa, we took out some year-end price targets in Thursday's session, and some.
Yeah, and people had to change their forecast as a result. I'm struck, though, about what the market is expecting from Fed Chair Jay Powell this week, in addition to other Fed officials. Are we going to hear yield curve control? Are they going to try to talk down the move? And what is the potential moral hazard, John, if they do, if they react to every
here's my
tantrum?
thing right now. They're more concerned by what happened at the long end, that huge intraday swing, or more concerned about a market pricing in hikes way before they're looking at doing interest rate hikes?
I think I think all of the above. Yes.
All of the above, yes. Coming up, 8 a.m., David Riley,
What is
Bloomberg
this,
Asset
CFA?
Management. I don't know, what was that?
Well, I mean, honestly, I have 15 seconds.
Usually
You want me to elaborate on that?
so much to say.
I do have a lot to say, but not in
So
10
much
seconds.
to say. All of the above, yes. Futures up 40. We advance 1%. And now I've got to work through some time now. Try and make up for it.
Instead of just blaming me for running up against the edge.
This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Looks like the proposal for a higher minimum wage won't be in the coronavirus relief bill. Senate Democrats are shelving a plan to use tax hikes on big businesses to get them to raise wages. The concern is it wouldn't be possible to get all 50 Senate Democrats on board. The House passed a relief bill over the weekend. Immigration will be the main topic when President Biden holds a virtual meeting with Mexico's President Andrés Manuel López Obrador today. The Mexican leader plans to propose a labor program that could bring up to 800,000 immigrants a year to work legally in the U.S. A senior administration official wouldn't say whether President Biden supports the proposal. And President Biden is urging Amazon workers to vote in an Alabama unionization drive. He says employees should be able to make their own choice about whether to join a union free from company pressure. Mail-in voting for the 6,000 warehouse workers began in mid-February. And Andrew Cuomo has gone from being called America's governor to facing multiple scandals. A New York Democrat now faces an investigation over allegations of sexual harassment. Cuomo's also been hurt by revelations his administration hid a number of people who died from the coronavirus in nursing homes. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
It is scary to think, particularly given all the liquidity that the Fed has pumped into it, that we still find ourselves in this situation. So yes, expect that choppiness because there are structural issues at a time when we've got more and more Treasury securities being put into the world that need to be absorbed.
Marvin Lowe there, State Street Senior Global Market Strategist, touching on the supply issue. We're light on supply this week. A lot of T-bills next week, 3s, 10s, 30s coming from the Treasury. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. We look like this. We're up 39 on the S&P. We're up a little more than 1%. We bounce back and take a bite out of last week's losses. In the bond market, yields are higher by 3 or 4 basis points to about 144. And Tom, you've mentioned it a couple of times this morning. Mixed in G10, but there's that dollar strength against the euro. Euro dollar 120.45.
John, thanks so much. Right now, we want to do a value add for you to get the Monday started, to get your March started with a reset on China. We welcome all of you on radio and television. And to Curran, our Chief Asia Economics Correspondent, and he gets us started for a good March. How is the March of China looking, Enda?
Well, look, we had some PMI readings today, actually, Tom, which showed something of a softening in the month of February. But the thing to remember is those readings were really distorted by the annual New Year's holiday in China.
Yep.
And, of course, it coincided with a period of restrictions around the coronavirus. But the broader economic rebound story in China remains very much on track. Manufacturing and exports are going gangbusters, and the consumer is holding up too.
And doesn't it just drive you crazy that every time we get a downside surprise out of China, it's somehow seasonal? Isn't it always somehow seasonal when it surprises to the downside? We knew this already. The economists still got it wrong.
There's an excuse for everything, John. You're absolutely right. I do think the month that we just had was distorted by various factors, though, and it's hard to strip away exactly the impact of the holiday. But I think overall, even if you were to say that the Chinese recovery is plateauing, we know that the forward-looking indicators on forward orders remain strong. We know that, take South Korea, for example, their exports of chips are going gangbusters, and that reflects on the kind of production and manufacturing that's happening in China, so it's reflecting Chinese demand. And we know that Chinese consumers holding up too. They're not back to where they were pre-COVID, but they are starting to spend again. So even if you were to say, look, the recovery in China is going to plateau a little bit, it's certainly not in a bad state, and it has been a much faster recovery than we were even a year ago.
Has the vaccination schedule in China been much better than expected as well? How is that factoring into your future expectations?
Well, it's slower in China. It's been slower actually all across Asia, in fact. So there's kind of a bit of a narrative now with Asia, that Asia was first into the virus, first out of the virus, but there's some people saying now we might be last with the vaccination process. Different reasons for that. There's less of an urgency in China and elsewhere to roll out the vaccinations because, of course, infection rates are somewhat low. But at the same time, a lot of people are saying this process is going to have to begin and start in earnest if all of these economies are to get back in sync with each other through open trade and borders reopening and all the rest of it. So I think you will see over the coming months, and we may even get some detail this weekend at the National People's Congress, I think you will see an acceleration of the vaccination process in China and indeed the rest of Asia.
And the recovery continues. I'm just struggling to reconcile it with the calls for another super cycle in the commodity market. Now, a metric that you're familiar with must-watch metric out of China, China credit impulse. That's been rolling over, Ender, for a period of time now. Can you just walk us through, A, what it is, and B, what your read of it actually is right now?
Well, look, the point to take on that is that China's recovery hasn't just been based on exports. A lot of it has been down to public spending on infrastructure and other government-related projects in particular. And also through the banking system, the central bank has been channeling a lot of money through those banks to small and medium-sized enterprises or to the parts of the economy that need it most. So the China recovery story has relied a lot on public money and on public support, and that's expected to continue. That's why this weekend we're going to get the National People's Congress, where we'll get the economic plan for the year ahead, Jonathan, and that will give detail on whether or not they're confident enough now to start tapering some of the support, pulling away some of that credit, ramping up a kind of a deleveraging cycle that they've talked about in the past, or whether in fact they will keep tipping some of that cash into the economy. So I think we'll get more guidance on that at the weekend.
And what does the new Hong Kong look like?
Well, it's a big question, Tom. There's no doubt that confidence has certainly been eroded, if not shattered, in the city over the past year or so. We're in the middle now of another protracted series of charges of pro-democracy activists. I think that there's kind of a dichotomy going on here. On the one side, the financial market and banking side of Hong Kong is carrying on, so to speak, but obviously the civil liberties side and the pro-democracy movement is under a lot of strain.
How are they linked together? I don't mean to interrupt, Enda, but this is so important to our global audience. How is the financial part of Hong Kong linked in any way to the people of Hong Kong?
Well, it's about a quarter of the economy, the broad banking financial services system, so it's a huge employer. But, the financial market here is plugged into what's happening globally. It's plugged into what's happening with China. There's a lot of liquidity around. The markets are booming, so profits are up. That side of things is holding up. But obviously, you can't implement a strict national security law that Beijing is implementing without everybody being impacted. There are concerns about what it means for research at banks, for example, concerns about what it means for calls made by institutions on selling Chinese stocks and bonds and the like. So nobody is escaping this national security law crackdown in its entirety, but there is some divergence on the ground. That is, you've got the financial market side of Hong Kong continuing to motor away, but the civil liberties and the pro-democracy side of things certainly feeling the blunt of the hammer blow.
And when we talk about Hong Kong, I think about foreign policy. And when it comes to China, really at the forefront is Joe Biden's push to recast the rivalry between the U.S. and China as one for technological superiority and the race to be the leader in semiconductors and an independent supply chain in the United States for key aspects. What's China's response been to Biden's tone?
Well, this is it exactly, Lisa. I mean, I'll just point you to the export figures out of South Korea today that show huge demand for these semiconductors, and a lot of that is down to stockpiling by China. So they are hoarding what they can in anticipation of a kind of a U.S. pushback on this front. China themselves have identified technology as one of their core industrial pillars, and this weekend, as I was saying, we'll get details on the new 5-year plan. They will flesh out their ambitions, and a big part of that will be technology, and that will feed into this idea of dual circulation or more self-reliance. It's kind of an old idea warmed up, but China seems to be getting more serious about it, and they're going to want to produce much more of their own technological know-how at home, and that includes semiconductors. So I think you're absolutely right, Lisa. Chips and semiconductors and the likes are very much on the front line of this next phase between China and the US now, but China is clearly already moving preemptively, and that's why, as I say, we'll get some more details on that from the 5-year plan in the National People's Congress.
The United States taking it a whole lot more seriously as well, and good to hear from you. Stay well. Bloomberg's Ender Curran there on a situation between the United States and China just at the end of the conversation. And Tom, I think it really fuels the conversation about industrial policy that's taking place here in the United States and coming together under the new administration.
I think it underpins, John, the major call of this year, which is how long do we sustain GDP? We can't sustain GDP unless Asia and China sustain.
You can't sustain this commodity market rally without China really contributing. We know that too. Coming up, David Riley, Blue Bay Asset Management Chief Investment Strategist. You sound like Lisa, Tom.
Markets are just
markets up 40 on the S&P. We advanced 1%. This is Bloomberg.
never sleep. So stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Rates to keep rising, but we need to do it in a slower, more orderly fashion.
The market is pushing the Fed as to whether or not it's going to be able to hold the line.
Consumer confidence is going to come back and they will be spending.
The reopening is not even in the market yet. This value trade is still relatively new.
We do have inflation. We do have inflation fears. That is good for the reinflation trade. That is good for the cyclical trade. And that's where we want to be.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It is a simulcast on radio and television. Thrilled you're with us on a Monday. There was Thursday, a 4-day week, and then you get to Friday, which is the foundation for the lift up we see this morning. John, forget about bonds, forget about currencies, forget about commodities. Stocks lift.
Small caps lift. The Russell rallying. Tom, on the S&P 500 as well, up 39, 40 points higher on the S&P. We have a lift by 1%. Jonathan Golub in the previous hour, I think, was really terrific. Talking about how much we've seen a boom in the cyclical parts of this market, the financials, the commodity players and elsewhere, Tom, and put him together with Laurie Calvasina of RBC. And this idea that we still haven't seen the full allocation, the broad-based participation with the winners of the year so far.
And John, I went out on Twitter today with Anthony Dwyer of Canaccord Genuity, whose great theory is if there isn't a recession, markets don't go down. Okay, it's a generalization. I know I'm going to get a lot of hate mail on this. John, the fact is we're looking at 6 or 7% hate mail on this. John, the fact is we're looking at 6 or 7% real GDP.
Yep.
It's difficult to go down given that economics.
Tony would say, look at credit, look at the primary market and the credit market, and look at the supply, and things are still okay. This is not the back end of 2018, Tom. It's a very different environment.
Lisa, you're reading over the weekend the tantrum that we saw. It was a tantrum. Let's not make light of it as well. What is the outcome of your reading?
Well, the outcome is that there still is borrowing costs at very low rates, but you did see companies start to race to get into the market last week, thinking perhaps yields are going to rise. They better get in while the getting is good. Although I'm trying to pair the message that you're talking about from Jonathan Golub, from Laurie Calvasina, with the message that we heard from Matt Hornback, which is that the Fed has to come out and say something this week to talk down, to calm down the rates market. I'm trying to figure out the consistency here of the urgency may be felt by Fed officials paired with this incredible optimism still seen in equities.
John, we saw 3-4 standard deviation moves in bonds. I would suggest the market's doing the calming down for the Fed.
Totally agree, because the Fed hasn't said anything about calming down yet. And I say yet because they've got plenty of opportunity to later this week. And I asked this question a little bit earlier, Tom, and it's an important one. Are they more concerned about what's happening at the longer end of the yield curve and the volatility on Thursday in, say, 10s and elsewhere? Or are they more concerned about the market pricing in rate hikes prematurely? Two interesting stories taking place.
And I didn't really have an answer for you last time because I didn't have that much time. I have a couple more seconds, and I want to just say on the short term.
You've had an hour.
Okay, an hour lecture on Fed policy. The short term, they're concerned about the market pricing in premature rate hikes that stymie longer term inflation. That speaks to those lower inflation expectations that we see over the longer term. On the long end, on 10-year, on 30-year Treasury yields, that affects the borrowing costs of the United States and the willingness of fiscal policymakers to borrow more money and invest in the economy. Both are a concern to the Fed. The question is how they achieve rates at a level that they see as sustainable.
Where are those short-term rate hikes? Where are they modeled in on the calendar?
Well, they're already starting to be modeled in for 2023. And this is a concern.
Lisa,
or even the
in
2022
the old days,
that we're starting
worried
to
about
do.
March 17th of the Fed meeting afterwards. And if we really reached out, let me get it up here right now, John. I can do this on the Bloomberg Professional Service, on radio, on TV. March 17, April 28, and June 16th, Lisa. That used to be long-term Fed gazing. Now we're out to 2024.
But Tom, the new framework, the whole point of the new framework, the new reaction function, the whole point of the communication of the last 9-10 months has been to say, we're not going anywhere.
Right.
We're not going anywhere. And the market's getting ahead of it. And we're not going anywhere, even if the data gets better and the market's still getting ahead of it.
I'm looking for an entry point, Lisa. Let me look at the futures, up 41 points. Dow futures up 326. I'm trying to get in 3 big figures on the VIX. John, there's so much carnage in the markets. We're cratering. What do you note in data?
Got to look at the yields on the bond market, back up 4 or 5 basis points. And I'd say take a look at the FX market as well. So the low yielders, the Swissy, the Japanese yen, weakening up against the stronger dollar. The commodity currencies is where your outperformance is in G10 today. Norwegian krona, the loonie in the mix as well.
Listen to you.
But it's the euro, Tom, that I've got my eye on. Euro dollar 120.46.
Exactly.
And whether we do start to see a stronger dollar that bites off the back of this conversation about US exceptionalism, will we hear more of that soon?
We did not get to a 119 on euro. For me, that's a huge deal. And I'm going to take it off the vaccines and the glorious numbers under 2,000 deaths I'm seeing in America today. Let us bring in, within all that we've covered here on a March 1 to get you to that final month of this quarter, David Riley, Blue Bay Asset Management, with us with a broad swath. What part of the market, David Riley, are you most focused on into March?
The biggest focus kind of echoes the discussion you've just been having, Tom, which is, I think, more around the short end of the US rates market. I think that the Fed...
Okay, guys, I'm placing a stop on profit for euro at 120.45. Okay, stop on profit placed, 120.45. So whatever happened, you know, nothing will end up with losing this trade. Let's see what's going to happen. Maybe we'll increase our stop on profit. Okay, well done, all of you who started this trade with me.
Going to be consistent with the forward guidance I've given around tapering and the forward guidance I've given around allowing inflation to run above target for a substantial period of time. So I think just, you know, right now, kind of keeping an eye on the front end of the US curve and rate expectations, and, you know, then how the Fed potentially reacts to that.
Well, it's totally inconsistent with the guidance we've had so far, David, and maybe the forecast change that in the next month. But I think a lot of people anticipating better economic forecasts, but keeping the monetary policy outlook basically the same. Chairman Powell speaks Thursday. Do you expect him to change the script?
I do expect him to push back a little bit in terms of, for the first time, in terms of what we've seen in the rates market. And I think what he'll try to do is just sort of reiterate that, you know, the QE is going to be here through this year, and you know, tapering is very unlikely to be kind of brought forward, and that in itself, I think, will help kind of calm down some of the sort of shorter end. But as I say, it's been interesting because you know, if we look at obviously what the Reserve Bank of Australia has sort of, you know, has been tested, it's stepped up its bond purchases. I mean, the commentary out of the ECB clearly has been signalling concern around higher rates, and you know, the Fed really haven't pushed back in any real shape or form against those higher rates, and it may require you know, a more serious kind of wobble in risk assets for it to do so, because it's clearly, you know, looking at what risk markets and financial conditions as a whole is doing. And again, Lisa mentioned, you know, credit markets have proved very resilient to higher yields so far, at least.
RBA decision a little bit later tonight. David Riley, do you know what's interesting for me and some others as well? The bond market didn't lead this move. Back end of October, we saw the cyclical parts of the equity market rip. We saw credit rally, and Treasury yields really didn't do much until basically the last month, when real yields just exploded. Much of the last 6 months has been dominated by inflation expectations. What is it about the way this market's set up right now that real yields weren't some kind of leading indicator. They almost lagged a lot of this, David. Why?
Yeah, well, I remember, I think we had a conversation, sort of, Jonathan, that we were talking about the sort of reflation theme going into this year and how that was being played out in that sort of, rotation from sort of growth to value, defenses versus cyclicals, but it has actually the bond market hadn't really responded to that. So I think you're right. I think the bond market has been catching up. I think what was really been the big change is the Georgia Senate election results. The fact that the Democrats have, admittedly a wafer thin, but nonetheless have a majority across all of the Senate as well as the House and White House. And so, we have seen a pretty meaningful increase in growth expectations since the start of the year. And I think, the bond market is now responding to that. But this is where I think you were alluding to before. You get this kind of paradox is that the Fed want to, signal is going to say so very, very dovish, keep rates unchanged, even until 2024, and allow the economy to run hot. The danger there is that the bond market sort of says, yeah, but hold on a minute, I'm a bond investor, and that implies that inflation is really going to pick up potentially. That certainly increases the tail risk. I want to be compensated for that, and that in turn actually leads to a tightening of financial conditions and a wobble in risk assets. So how does the sort of Fed sort of tread that line, if you like, from being perceived to be too far behind the curve, and ultimately that meaning rates ultimately end up being higher than they otherwise would be.
David, just 20 seconds here. Just investment grade credit has sold off. We could see a 3% decline year to date. Is this a buying opportunity?
Well, I think that itself has really been about duration. I think duration, interest rate risk is going to continue to be a headwind for high grade credit. I prefer to be in higher yielding credit where it's shorter duration and you still got a little bit of spread cushion, and some of the shorter duration assets like leverage loans and collateralized loan obligations.
Duration risk has been a story. David, great to catch up, sir. David Riley, Blue Bay Asset Management Chief Market Strategist from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bravis, I'm Jonathan Ferro. Busy week ahead. Ton of Fed speak. Chairman Powell concluding that on Thursday. And then on Friday is the payrolls report. Let's get to the price action of this morning. We settled down. We stabilized. We rally. We bounce on the S&P 500 up 42, up a little more than 1%. Talked so much about the bond market. Just really quite violent in Thursday's session. Yields topping out at about 161, just short of that level in Thursday's session. We're back down to 144, even with a 4 basis point lift on a US 10-year this morning. On a 30-year yield, we break out just a little bit more on 30s. Yields up 6 or 7 basis points to 2.216%.
Oh, the carnage. It's terrible.
How was the long weekend, Tom?
The VIX is in 3 big
feel
figures.
Rested.
I'm looking for an entry point.
Oh, yeah.
It's not
What
there.
did you do on Friday?
What did I do? I had kennel fee. We went to puppy training.
Very good. You training the dog?
The dog's training us.
Was it frustrating to train the dog? Just comparing and contrasting.
Oh, dear Lord.
$100 an hour.
He's got no idea where I'm going with this. From New York, Greg Valier coming up shortly. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Senate Democrats will not try to raise the minimum wage as part of the $1.9 trillion relief package. They had considered including tax penalties on big companies that pay low wages, along with incentives for smaller companies to pay a higher minimum. But it became clear over the weekend that getting all 50 Democratic senators on board would be difficult. The House passed the stimulus bill Saturday. Donald Trump told a group of conservatives he's laying the groundwork for a third presidential campaign. The former president stopped a hair short of declaring that he's a candidate for the 2024 race. Still, his 90-minute speech in Florida made it clear he thinks he's the best choice for the Republican nomination. And Iran says it's not the right time for direct talks with the U.S. and European powers on the nuclear deal. Donald Trump pulled the U.S. out of the 2015 agreement. President Biden has offered to take part in talks to revive it, but Iran wants the U.S. to lift economic sanctions first. American freight railroads are launching a lobbying campaign that depicts their industry as a solution to climate change. They've come up with policy proposals that they say would help pare greenhouse gas emissions.
Okay, guys, I will move my stop on profit higher to 120.48. Just right here, 120.48. So all of you who follow the trade, who started with me, you need to move your stop on profit, okay, to 120.48. Okay? I'll speak to you later.
Of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19.
Okay, guys, well done. We close trade, so you can see where we close it. It's all like I said, it's all about how much your broker pays you per pip. So in our case, we have £100 per pip. In your case, you can have £30, £10, £15, £50. So you can calculate, in this trade, we made 5 pips. All right? Well done. Let's see what other pairs will bring us today. Maybe we will catch another trade. Well done. I'll speak to you later.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash.